Well, everybody, welcome back to the Real Estate and Mind Show. I am your host, Glenn Schwarm. As you see, I am here alone today. My beautiful bride is actually getting our kids from summer camp. Tis the season, right? Tis the season of summer where we're getting our kids doing all kinds of stuff and we're going 100 different directions. I thought we were supposed to relax in summertime. I don't know what happened to that. I thought we were supposed to relax, but it seems like we're not relaxing as much as we should during summertime. So listen, so I am here today and I'm looking forward to a conversation that we're about to have with our guest, who has also a lot of experience in real estate investing. And you guys know that Amber and I our main mission in life is to help everyday people build wealth through real estate investing. So just having a few minutes of conversation and hearing what he does, I'm looking forward to having him here. So I want to welcome Mr. Dr. Phillip Hearn from Mid-American Capital Holdings. Got that right? Right?
You got it right. Yes.
Welcome to our show today. Glad to have you.
Pleasure. Thanks for having me.
Yeah. Tell me where you're from. Whereabouts in the country are you from?
From St. Louis, Missouri, born and raised.
St. Louis, Missouri. Very good.
Yeah,
All right.
yeah.
Missouri.
So the big question that we have here, everybody always asks, where'd you go to high school? No one else cares in the country, but that's our big thing. So we always ask each other that.
Why is that?
It's just one of those local things where if you know where somebody went to high school, you start to be like, it's less than 6 degrees of separation. You've heard of that Kevin Bacon thing.
Yeah, sure.
It's about a degree to 1.5
Okay.
degrees here. So.
Oh, very good. So before we jump in, tell me about the doctor. I want to know what kind of doctor you are. Are you? Tell me. I want to hear about that. You've earned some props here. Let's hear about it.
I appreciate that. So doctorate is in education with an emphasis in leadership and management. So finished up my degree in December of 2020 at Capella University. And I'm glad that portion's over, but I was excited to obtain that over the time. So
I want to hear that again. Doctor of Education, but a focus on something in leadership. What was it again?
Leadership and management. So I grew up a lot with teachers, administrators. So I've always been a bit of a research kind of guy. I love always being a student of what I'm working on. So one of my mentors actually has their doctorate in actually the similar field. But I feel like I can use that for educational purposes when it comes to anything that I'm working on within our holding company. So including real estate. I've made enough mistakes for other people. So I try to teach them sometimes, of course, what to do, but especially what not to do over the years.
Yeah. Well, that's pretty impressive. I didn't know you get a doctorate in that. You know, so one of the companies that Amber and I own is a brokerage. That's what we mostly flip houses and teach people, educate, all that stuff. But one of the companies we have is a brokerage, and the way Amber got to become a broker we live in Florida, but it's actually in New York State. And she got to become a broker because of the credit she had earned just because of her experience. So she automatically became a broker. Like we filled the paperwork out and they said, have you had schooling? No. I was like, how many deals have you done? At the time it was like 700 or whatever it was at the time that we did that. Now it's been like 1,000. She wrote the number and they said, okay, you're qualified. So I'm wondering if I could be a doctor because I've had lots of time too. I've had lots of qualifications. So I'm wondering.
Look, I'm sure you can make a couple of calls. I'm sure we can make that work for you. Yeah, let me get on the phone after this and we'll figure that out for you. Absolutely.
I've never been a very good student. I'm more of a student of life than I am. But a lot of mad props to you, man. That's fantastic. I didn't know you get a doctorate in something like that. So that's pretty cool.
It was enjoyable. Thank you so much.
Yeah, no, very cool. So tell you're obviously in real estate. Tell us how you began your career in real estate. I want to hear how that kind of got started and take us on that journey.
Yeah, so it actually started by accident. I always call it the smartest, dumbest thing I ever did. Smart because it got me into the business, still in it 20 years later. Dumb because I had no idea what I was doing when I started out. So I got into real estate when I was 17. Bought my first property when I was 20. And I had no idea what I was doing. So I was learning a lot on the fly. I was really good at putting holes in stuff. So if you need a demo, I was your guy at that point. So, but over the years kind of evolved that. But it's been fun for me just because there's so many ways to attack real estate. And I'm actually the first in my family to really go down this road, real estate, construction, those types of avenues. And starting it at such a young age and then now seeing where the industry is now, seeing the opportunities that I've been able to run into over the last 20 years, it's definitely been some life lessons, but I've enjoyed the process.
Let me ask you this question. So a lot of times people that have a title like doctor, I don't care if it's a doctorate or if it's a medical doctor, whatever it is, they come from a long line of people that have done the same thing. Is that true in your case?
No, it's actually a complete 180. So I grew up in St. Louis, grew up actually in poverty. So portions of St. Louis City, and learned a lot of this on my own. So just with mentors or contacts over the years, but just really tried to figure it out. I had an interest in the concepts of real estate from a young age of loving seeing the before and afters. I will admit, back in the day, I was a big HGTV fan in terms of seeing all the before and afters. Now I understand a little bit more about it, but those concepts were fun. But then also having an opportunity to really positively affect the community was definitely something that was of interest to me, especially with the background that I grew up in. So for me, it was an opportunity to kind of grow, expand. But again, just the twists and turns in the industry over the years for me, it's been something that I couldn't have imagined in certain spots in my wildest dreams of things that I've been able to see and do and be a part of over the years. But no, this was kind of my own journey.
So you're very much like Amber and I. I was brought up. We were poor. My parents both worked multiple jobs. My dad was a butcher. Mom was stay-at-home mom, but drove bus, and just trying to figure it out. Right. I didn't know we were poor growing up. My parents, well, my mom griped about money a lot, so I knew we didn't have any money. She reminded me every time, turn the light switch off. We can't afford. Stop eating so much. There's all that going on, and I was the baby of four boys, so I knew we only bought groceries during paycheck. My dad worked. He was a butcher, but he got to be a butcher for the federal government, so at least we had. They knew every 2 weeks a paycheck was coming. That's when we got to eat, right? So mad respect for somebody who is, because Amber and I have built from nothing. So if you ever know our story, we built from absolutely nothing. So when I hear someone else that built from nothing, how does somebody that's brought up in poverty get into it at 17? I started business young too. I opened my first business at 19. So 17, how does that happen? Because you're probably not around real estate investors when you're 17. If you're like my kids are around real estate investors, right? They know who we are, they know what we do.
Yeah.
Sounds like you didn't have that example. I'm curious of how did you get involved at 17 and what did that look like? And who were your mentors early on?
Yeah, great question. So there's actually two parts to that. So the how it started almost was a bit of a dare. And so I'll explain. So I was I was with my adopted family. So my adopted father at the time, and I'm like most 17-year-old boys, as we all are. Hey, I want a big Jeep. I think I wanted a Jeep Grand Cherokee, right? Sure. So that was the first thing on my mind.
Sure.
And he looks at me one day and he goes, "Why don't you buy a house?" And just walks out of the room. And there was a couple other colorful pieces of language, but that's the cliff notes, right?
Sure,
so he walks out of the room. And so how my brain kind of kicks in is, again, I'm a student. So I know everybody goes the doctorate, I've got a couple masters. And so that's one student language, right? The other part that I really enjoy when it comes to real estate and construction even is learning about certain processes. And so what I started to do is I started to research on my own properties in town, right? So what are they going for? Trying to understand my market a lot more. And then over time,
St. Louis area.
Yeah. In the St. Louis market. And I, everybody was thinking, hey, you can fix and flip and how do you do it? And, first time home buyer and all those types of things. So part of the start is a dare.
What year is this roughly? What years?
This is around, oh my goodness, 2002, 2003 timeframe.
Okay. So pre the last downturn in the economy.
Yes. Yes.
Okay. I'm just trying to get an idea of time frame. So got it.
Yeah, which seems like 100 years ago, right? Prehistoric times almost, right?
It was a long time ago.
So I started digging into my own research and trying to figure out, if I was going to flip a house, what would that look like? So really just trying to learn. And so I started crushing books and just anything I could get my hands on in terms of trying to figure it out. And so then over the years, I would pick up mentors in like the local real estate game. I'd go to the local RIAs. So all of those types of experiences were really helpful because you could see, again, not just what was working, but some of the pitfalls. Okay, try to avoid this, try to make this adjustment. So it was just kind of I'm a little stubborn and competitive. So those are two of my traits, right? So if you give me a task or you tell me, hey, go buy a house and walk out of the room, I'm be like, I am going to buy a house. So that's kind of how it started.
Yeah. So how many deals have you done since then? You've done quite a few deals.
Well, I almost break them up into different timelines. So I'll give you the timelines.
Sure.
So I've been a part of and put teams together for over 250, almost 300 flips here in the St. Louis metro area. And then also I've worked with developers, contractors, builders. I look at that almost just with the sheer number of dollars we've worked with in that. So over $1 billion in projects. And so that's been anything from ground up work to facilitating and procurement of equipment and labor and materials. So I've had almost different lives within this one life. So it's been kind of fun, but that's almost how I look at it. Been a landlord as well. So the number of deals, one day I'll sit down and I'll count the exact number. I owe you. That's my homework assignment to you.
Yeah. But it's very difficult, especially when you're doing like our company still does about 100 deals a year up in New York. So I can't keep, I don't know. After a while, it's like, I don't know. I don't know. Maybe 800, maybe, I don't know. I can't keep track of it after a while. And it's funny. It's not about, for us, it's not about the deal anymore. It's we actually do get a real passion to help other people. That's why we do podcasts, so people following, all that stuff. We like to help, again, like I said, everyday people create wealth through real estate investing. Because my saying is, because that's who we are, and that's what we did. So that's what we always say. So you took your business in a little bit different direction. I think I was reading a little about you that you went into some seller financing stuff, which I find interesting because here's what I love talking to you about. You, like us, we started flipping, we bought our first house in 07. Well, take that back. We bought our first rental like in 03. Worst thing we ever did, worst rental. Still have it to this day. I'll have it forever. I finally had to put 200 grand into it like 8 years later, but whatever. But really, we flipped our first house. We bought it in 07, 08, and the market disappeared from us. And so we have been grinding since then. So we've been through that. I find today, especially even doing podcasts stuff, there's so many people out there that have only experienced the good times, the crazy market. And they're like, I am so good. And I'm like, no, you're not. you don't know how good you are till you're tested. You don't know how good you are. So I love talking to you. You've been around since 2002, so you've seen those things. And as we transition the conversation kind of into seller financing, you sort of transition, it sound like, from fix and flips to into some seller financing. I want to hear about that transition. That's something that's going to be probably coming. With interest rates skyrocketing, seller financing becomes very interesting. All of a sudden, these new ways to get deals done is very interesting. So you're on here at a great time. So so talk to us about that. Tell us about your evolution from where you stood with fix and flips, and I think you sort of moved into sales. Let's hear about that. I'm curious.
Yeah, absolutely. So after working with a hedge fund that bought a ton of properties, and so I was leading construction teams here in the metro area to do their fix and flip. So some of these, we had the range of them. So we had stuff that honestly probably should have been knocked down. I don't want anybody listening to this, but probably should have been knocked down to sometimes it was, right. Yeah. I'm sorry. I'm very sorry, Miss George. That should have been knocked down to something that, sometimes was lipstick on a pig, very quick, paint, looked good, ready to be rented out. So I kind of got burnt out after that, to be honest with you. That was an intense time frame. And so again,
have you explained to our listeners what a hedge fund is? Most people probably know, but I think it'd be good to hear someone who is in the hedge fund. You describe what it is.
Absolutely. So it is basically a large group of investors. So they buy up swaths of property, land, usually in an area. So this particular one had properties in St. Louis, I believe Kansas City, Indianapolis. And when I say large, I think they had 700 to 1,000 single family homes in St. Louis alone at one point in time. And so what they do is they'll, try to fix them up, see if they could rent them out. The worst case, they sell off that full package to maybe another hedge fund or a capital fund. So basically a hedge fund is just a large conglomerate of investors, if you will, simplest way to think about it and kind of move it from there.
They're single family homes, and really they're banking on a lot of appreciation. That's really what they're banking on. I think so, because single family homes are notorious for not having great cash flow. They have cash flow, but not awesome cash flow, but really they're banking on appreciation. Would you agree?
Yeah. And sometimes even depreciation as well. So using that on the tax return too. So you can kind of play that both ways, which is all the benefits of real estate.
I don't know if I thought about that till you just said that. You're right. Like I hadn't thought about that, but you're right. Yeah, they get to use those tax laws to their advantage. So, all right, I didn't mean to take you off sidetrack. I just think that people need to, because some people might be going, I've heard of a hedge fund, but what is a hedge fund? So I figured, well, we got a hedge fund former guy on here, we could talk about it. All right, so now take us through that. So now you were sick and tired of the hedge fund.
Yeah, no, just sick and tired of working with the hedge fund as a contractor. So doing more of that fix and flip work, kind of in the weeds. And again, love the process, but just all of the minutia. So again, it's not quite flip this house, right? So it's not, you just snap your fingers and you're done with the project. I mean, there's 6 months of craziness or 3 months of craziness or whatever that may look like. So I started to kind of research ideas of becoming your own bank. So somebody actually handed me this book, and I got to remember, it's probably around 2013 or so at this time. So I get a book by R. Nelson Nash called Becoming Your Own Banker. And I really sit down and start reading through this book. I read it, I think, like 6 times in a weekend because I was like, this is insane. Like no one teaches you this, right? No matter what the educational pickups that you get for the most part, they're not teaching you how to become your own bank. So I started to look at that and go, okay, how do I leverage that not only in real estate, but potentially other deals and opportunities that I may have? So I started to study how to pick up mortgage notes. So basically, as opposed to paying a bank, you are the bank. So that mortgage payment, principal, interest, all of those things, taxes, insurance are all paid to you or your entity, of course, as opposed to you paying a Chase or a Bank of America or something to that effect. So I started to try to understand that more. I even started to understand how to use that same principle when it came to other assets, such as heavy equipment. So we, within our holding company, own heavy equipment, but we also can sell our finance to clients of ours. So we play as the bank when they can't go and get normal banking rates. The last piece as well to think about, and you mentioned this perfectly, when you really understand seller financing, 2 things. It's a game changer because it's the additional advantage compared to just fixing and flipping, right? So it's another piece to the puzzle. So in case you can't go right to the market and fix and flip it, if you sell or finance it well enough, now you got some options. You can sell a part of the note. You can sell the whole note. So you've got options there. Second, seller financing is one of the unique things that really, no matter what the economic environment, there's always a need and a benefit for it. So case in point, if you say, hey, I've got 1,000 properties, right? So you and your wife, I don't want to go to the bank. I can't go to my bank. I've tapped out my banking relationship for now. I mean, they still like me, but I can't just go tomorrow and go get a bank. Sure. I may have a property that I can sell or finance to you. Now, the rates may be a little bit higher compared to a bank, but it's a little bit higher because you can't go to a bank, right? And that's in any economic time. So, of course, we talked about, everything's going on with inflation right now as we record. Everything's going on economically. Seller financing is a pretty good spot to be in, no matter where the economy, where inflation may be.
Sure. How does somebody get into seller financing that? So here's let's talk about some mechanics, if you don't mind. Can we dive in a little bit?
Please. Yeah.
Because I'm always this is interesting. So let's say I flip a house, and maybe if I go through this example, you say it doesn't work here, then I'm totally fine. But I want to learn. So I flip a house, and instead of selling it outright, I do seller financing to a new buyer. But what if I need the cash out of the property? Because I got to pay off my hard money lender or my private lender that lent me the money on it. Am I off base, on base? Is that a bad question?
No, because I think there's still a way to attack that. So case in point.
Yeah.
And so we're going to assume, for example's sake, because we can get into the weeds and we would be on the phone, we'd be on this for 3 or 4 hours.
I get it.
But let's say that the numbers play, right? Let's say that the numbers play. So when you're creating a loan for seller finance, you have an opportunity to potentially sell a part of that loan or the full loan to pull cash out of it.
Okay.
So case in point, let's just say that you owe a hard money lender. Let's say you picked up a property for, let's make up a round number, 200,000. Okay. You owe the hard money lender 220, 230, all in by the time you get everything done. That property, by the time you've done it though, is now worth, let's just say 350, right? Yep. So you can sell or finance to someone who's like, hey, I can't go and get a traditional loan in the bank. So now we're the bank, right? So you sell or finance them for the 350. So keep it simple. They put 50K down. So now they're seller finance for 300,000, and they've done a 30-year mortgage, whatever the interest rate is, and we can get in all the calculations. In a scenario like that, you still have an opportunity to sell a portion of that 360 months worth of payments or all of that 360 month worth of payments. And let's say you decide to sell them all for this example. So you've got a note for $300,000. You receive a month or two. So there's some note buyers who will buy it brand new, especially if you've done things, if it's single family, you want to do things Dodd-Frank compliant. I'm not a lawyer nor an accountant, but covering all of our bases.
Yeah.
But if you do things properly with your paperwork, Dodd-Frank compliance, that's a big plus for single family homes and residential type homes. So now you have this opportunity where you have a note for $300,000. You've received, let's say, a payment or two. Some will buy it that early and say, great, we're going to buy this note and we're going to buy it at a discount. So a concept of a discount. If you're buying the note at 100% of its value, so let's say it's $300,000 at that time, that's on par, okay? If you buy it at a discount, let's say I sell that note for 98 cents on the dollar or 95 cents on the dollar. So let's just say, for example's sake, we have a $300,000 note, we sell it for 280. So you've gotten that 50K in down payment, you've gotten the 280, and you've picked that up within about a 60-day turn time. So you got 330,000. You can still go pay off your hard money, and then now you've made 100K to go to the next deal. But nobody thinks about that. Everybody's automatically thinking, I've got to put this on the market, I've got to sell it right now and go from there. Sure. So it just gives you another angle to potentially attack different marketplaces and different opportunities.
Do they, for some reason in my head, I always had that note buyers, and this is just not doing, I really just not a specialty of ours at all.
Sure.
So this is a good conversation. I always assumed they were buying notes discount more like at 80 cents on the dollar.
Great question.
You know?
So they can, but here's the kicker. If you've done the proper, so just like you guys do, I'm sure, proper paperwork is important, right? So if you're doing things where it's Dodd-Frank compliant, they can see the down payment. One of the things that helps in that scenario potentially is the seasoning. So they've put 50K down, right? Now, a lot of those notes where they're going to potentially pay, let's say 80 cents on the dollar, is let's say the down payment isn't as big. Let's say the down payment was 10K.
It's riskier.
Well, now, okay, you don't have as much seasoning in the game, but somebody put 50K down, let's say in that example. Okay, I'm willing to play a different thing. So it's like any other deal in the sense of there are specific terms that you really want to understand within your scenario. What's the interest rate in that regard? What's the down payment? Even though it's a newer note, maybe the down payment and the interest is good enough for me to go out and take a look at it. Have we done the paperwork in Dodd-Frank compliance? All of those things start to add up to, okay, I'm willing to pay 95 cents on the dollar. Okay. Or you haven't done that. I'm only going to pay 80 or 75 cents.
Yeah. Okay. Tell our listeners what Dodd-Frank is too. I know, just if you wouldn't mind, tell them
Yeah. So Dodd-Frank basically allows for protection for someone who is actually the borrower in that scenario. So basically, you can't have predatory loans out there. You can't say, and you know, I'm going to do a normal 30-year mortgage, but I'm going to charge you 40% or something crazy. So it keeps everything in compliance and it keeps predatory lending down. That's kind of the overarching view.
Those came into play a lot more after the last crash, right? That's when all that stuff came into play. So just to keep us from not going back there again. So
yes.
So tell people about your fund and how you're working with seller financing now. Like, how do you do it? How do you help people? I think that's what you do, right? You kind of get people involved and whatnot. So bring it. Let's hear about it.
So a couple ways we're working still with seller financing. So still, of course, doing seller financing on actual pieces of real estate, whether we're purchasing notes, creating notes, that's all within that seller finance realm. Again, as we talked about, we've actually expanded the seller financing to heavy pieces of equipment. So if you'd have told me as a city kid at 5, 6, 7 years old, hey, you're going to own, your company's going to own pieces of John Deere or Bobcat, physical pieces of equipment, I'd have been like, what are you talking about? So it's been kind of fun. Yeah, right. Yeah, I got a hat and everything. So I'm official. So
you're naming a deer? What is that? I don't get it.
Yeah. With that and a Bobcat hat, people are like,
Bobcat, yeah.
What are you doing? So we've used that as well also on. So anything, again, that's an asset, seller financing can come into play. What I'm really proud about is we just launched recently a capital fund. So this capital fund is going to focus on newly originated loans. The concept is this: the newly originated loans are on pieces of commercial property that already have equity from day one. And so we've created some partnerships with companies who basically allow our investors to guarantee that they'll get their principal back. They're short time windows, usually about a 12-month, with sometimes a 3 or a 6-month option at the end. But it's also, the way we've set it up is looking at everything with inflation. This can be a complement in your overall portfolio and try to take down some of that inflation hit. Because I know as we're recording, inflation is what, 8.3, 8.6%.
So they say.
Well, right. Right. If you get into the numbers, it's probably more, but we're going to say 8.5. So we try to give them an option to invest in those to where it basically guarantees their principal coming back to them. And again, we've got that structure. So we look at all the risk mitigation opportunities. We've got teammates on our fund that are national law firms that make sure that if we have to go into any foreclosure processes, they handle those things as well. So we've got a really good fund that we're putting together. I'm excited. It's my first fund as this particular group. I've worked with other folks who have done funds. So this is I've learned a lot, but also putting this thing together to where it's a real benefit to people that we can work with, investors who want to be more passive, that are accredited. And so accredited, they have to have a certain dollar amount of either net worth or physical worth. So there's a lot of accreditation laws. Again, not an attorney, but I try to study those and talk to attorneys as much as I can. So
the bottom line is that people that are accredited, and I think it's, what is it, about $500,000 or what is it? No, well,
I think it's.
I heard they were going to change it, so I forgot. Do you know what accredited investor, what the limitations are now?
I've got to look up the exact.
I want for a couple or 200.
Yeah, for 2 years. Yeah.
Something.
Yep. Absolutely.
Worth $1 million or something like that, or right, something like that. And that could be real estate. Doesn't be cash. Could be real estate. Could be whatever your
all their full holdings. Yep, you got it.
Yeah. So bottom line is that people can get involved with seller financing without knowing all the nitty gritty of seller financing. Is that what I'm kind of hearing?
Absolutely. So you can be passive or you can be aggressive, right? You can be very much in the mix, handling all the moving pieces or the contacts, or you can be more passive. So it's kind of like any other investment that we talk about in real estate. If you want to invest into a fund that does, REITs or rentals or whatever the case may be, you can be in the rental or you can be a bit more passive and let the funds come back to you.
What's kind of your plan for that fund? Where do you think you want to go with it? How big do you want to get it? What do you think you want to do with it? I'm curious. I mean, it's your first one. So I'm curious what you're thinking.
Yeah. So we've targeted and earmarked a $5 million fund. So this is an opportunity to really get into that space. And again, it's all the seller financing principles that we talked about, but the only difference is it's a commercial building, let's say, as opposed to a single family, right? But again, those pieces of commercial property, we do have full appraisals done by third-party national appraisal companies. So we know going in how much equity is in there already. So most of the loans that we structure are about 65% loan to value. So that means there's 35% of equity built in from day one.
So when you're doing, probably one of the questions that people would have, and I sort of have it, is, I think I know, but I want to hear your answer on it. You pick up someone seller financing, they can't get credit from the bank. Why? And why am I going to like them as a seller finance? Because if the bank doesn't like them, why do I like them? Now, I think a lot of that has to do with tax returns and business ownership. And as business owners, we're trying to pay as little as we can by claiming as little as we can with income legally and all that stuff. So I'm not an accountant, just like you're not a lawyer, I'm not an accountant. Right. I'm not a doctor like you either, so I don't know. But I think there's probably some questions people probably have, like, well, wait a minute, why is it a good risk for us? And who does seller financing? Great, take it away.
Yeah. So there's 2 points. So those are great questions. So let's look at the potential borrower. Okay. What we attempt to do is look at them and do the underwriting in a similar fashion, not the same, but similar fashion to a bank. So here would be reasons why someone, let's say, may not have the opportunity to go straight to a bank. You and I have both grown up. We've gone to banks a million times. If you've asked a bank for something 100 times when it has to do with money, how many times have you gotten a yes?
Well,
5.
Now I get a yes.
10. Well, now you're a big deal, right? Back in the day, back in the day, they look at you like, who are you? What do you want, right?
Yeah.
So that will happen sometimes even on the consumer side. So if they go into a bank and say, hey, I want to do this. And like you said, it could be anything from the tax returns. Let's say their credit score is not terrible, but let's say it's 640 and most of their criteria is 680, or they have dollars, but they don't have enough to make it go. So there's all these different reasons why a bank will say no. I always tease, and I have good friends that are in banking, and I tease them and go, you guys will literally say no if it's too sunny outside. Somebody will come in, have everything that you think that they need. You tell them, it's too sunny, we can't give you a loan, right? So it's not so much that you're just taking on someone that's got, a 350 credit score or anything like that, but they just may have a unique scenario to where they physically can't get a bank loan. And so a lot of times too, so now this is more on the lending side of it. When you're talking to folks that are doing seller financing, and let's say they give you an interest rate. So just as an example, they give you an interest rate and say, hey, you can buy this property. It's a 9% interest rate. People may freak out and go, well, I can go to a bank and get, now it's 4.5 or 5, right? But I always say to them, if you could go to a bank, then go to a bank. Yeah. And that's usually the disconnect. So, and then when you start to add the numbers in, principal, interest, taxes, and insurance, you start to add all of that in, you can actually build the monthly payment that they may have to pay based on what fits into their budget as well. So just because it might be a 9 or 10% interest rate doesn't automatically mean that it's going to kill the deal or they can't afford it. You're still going to work with them to figure out what they can afford. And a lot of times, last thing, they may be able to sell or finance and own the home as opposed to even renting. So again, it just gives you another avenue to play to where they might be spending as much, if not more, to rent. They could potentially sell or finance and put a little bit of money down, and now they actually own the property.
Awesome. This has been great stuff today, man. This is, I really enjoyed the conversation. So we are the Real Estate of Mind show. So let me ask you one question before we get your information to wrap up.
Please.
So we believe that you got to keep yourself mentally strong before you can have any cash in your pocket and wealth and happiness, all that kind of stuff. What do you do to keep yourself mentally strong? What's kind of your routine? What do you do, or any advice or anything about it? Curious.
Yeah, absolutely. So I try to stay active. That's one of my things. So I grew up playing sports. I played football, basketball, and baseball growing up. And so now sometimes I golf, and I'm using air quotes because sometimes I'm digging into the earth. That was been the last 3 or 4 days.
You're an excavator or golfing.
Man, on a golf course, they hate me out there. Yeah, I got to put so much sand down and just keep it together. But so a lot of it, number one for me, is staying active. So I like to work out, I like to golf. Just try and get moving, usually about 30 minutes a day. I have to sometimes push myself away from the laptop, worst case, go for a walk. So that's one. Number two, I really just try, when I can get away, I take that time to get away. When I was younger, I used to almost feel guilty. Like, okay, I need to sit still for a second. And so now I try to build that into, all right, I've been going hard the last 3 or 4 days. Give yourself a couple hours just to kind of sit still. Reading is always a big piece. So I'm always trying to read something, a bunch of different topics, anything from, like I said, becoming your own bank. I just read a book about mergers and acquisitions. So I try to keep myself sharpened, because a lot of times when you can tap into not only your own experiences, but other people's experiences, it sometimes will answer the questions that you have right in front of you. So try to stay active, try to give myself a break when I need to, and a good book never hurts anything.
Well, this has been great, man. So do me a favor, tell the folks how they can reach you. I can learn about your fund, give you some money, whatever they want to do, get to know you. Please do me a favor and tell everybody how they can find you.
Absolutely. So 2 ways to get in touch with me. One, we're actually finishing up all the website build right now, but midamericancapitalholdings.com will be the website. And then my email address is phil@midamericancapitalholdings.com. So that will go through all the different holdings that we have within that holding company. Anytime anybody wants to talk, connect, chat, see how we can be of service to you guys, and maybe even collaborate on some deals.
Awesome. Fantastic. Phil, thank you so much. It's been great to have you on the call today, and I look forward to it. Guys, we'll see you on the next episode of the Real Estate of Mind Show. Maybe Amber will be here next time. See you guys.